Legal tax strategies. The wealthy used to pay less. We all want to pay fewer taxes, but not many know how. The rich become richer because they know how to cut expenses and maximize their income. Paying fewer taxes legally is a game that the rich in high towers have mastered quite well. Finding legal ways to minimize taxes is a practice that almost anyone can master, regardless of income, net worth, or tax bracket. The current federal income tax bracket ranges from 10 to 37%, but if you are smart in claiming deductions and credits, you can get away with paying fewer taxes. If you want to stay in line with your various financial expectations, then saving on taxes is a must. You can do this by documenting all your expenses that could potentially be deducted from your income. Experts have suggested that there are more tax reduction opportunities for self-employed workers and business owners. However, even employed workers could reduce their tax obligations in some ways. You must understand that the results are not set in stone. What works for Peter might not work exactly for Paul. Additionally, you might not need all the strategies to reach your financial goals, but a careful application of some of these suggestions could be of great help. Different ways you can pay fewer taxes legally. 1. Retirement account. The first thing you might want to do is contribute to a retirement account. Contributions to retirement accounts are a tax reduction tool you can take advantage of. Contributions to traditional 401k and IRA accounts can be deducted from your pre-tax income. Consequently, this could reduce the amount of federal taxes you have to pay. These funds grow completely tax-free until your retirement at the age of 59 and a half. The currently taxable income can be reduced for contributions up to $19,500 to a 401k or 403b plan. If you are 50 years or older, then you could add $6,500 to the base contribution to the company pension plan. To get a clear idea of how this works, let's look at this example. Suppose you earned an income of $100,000 in 2020. If you contributed $19,500 to a 401k, that would reduce your taxable income to only $80,500. Contributions to workplace 401k accounts must be made by the end of the solar year, but contributions can be made to traditional IRAs until the tax filing deadline of April 15th. Currently, if you do not have a workplace pension plan, you can get a tax break by contributing up to $6,000 to a traditional individual retirement account, IRA. If you are 50 years or older, you can contribute up to $7,000. It is better to start early with these practices so that these accounts can help you secure your retirement. 2. HSA. If you have a high-deductible health insurance plan, you can use a health savings account, HSA, to reduce your taxes. This is similar to activities in a retirement account. For 2021, the maximum deductible contribution level for an HSA is $3,600 for an individual and $7,200 for a family. These funds can then grow without the obligation to pay taxes on the gains. Contributions to these accounts offer the following benefits: an immediate tax deduction. Funds grow without being taxed and can be withdrawn tax-free for qualified medical expenses, and any remaining balance at the end of the year can be carried over indefinitely. 3. Standard deduction. This is the base amount you can deduct from your total taxable income. This is quite simple to understand and apply. Anyone can do it. Let's pretend you are single or married and earn $60,000 in 2021. If you are filing separately, you can take $12,550, and you will be taxed as if you earned $47,450. If you are married and filing jointly with your partner, your standard deduction for the year will be $25,100. If you file as the head of a household, you get $18,800 in the standard deduction. Taxpayers who are at least 65 years old or blind can claim an additional standard deduction of $1,350. The additional deduction amount is doubled for anyone who is both 65 and blind. These figures slightly differ from the previous year. 4. Starting a business. Having a side business offers many tax benefits. Self-employed workers, full-time or part-time, are entitled to various tax deductions. This means that your freelance projects or other side jobs could save you significantly on taxes. Expenses incurred in the course of daily business can be deducted from your overall income. This could reduce the total tax to be paid. For self-employed workers, the following deductions can be made. 1. Health insurance premiums are available if certain requirements are met. If you pay for health, dental, or long-term care insurance, these payments can also be deductible. 2. An entrepreneur can deduct a portion of home expenses with the home office deduction. This can be done by strictly following the guidelines of the Internal Revenue Service, IRS. 3. The percentage of utilities and internet used in the business can also be deducted from income. 4. Vehicle mileage related to the business. 5. Shipping expenses, advertising, and website fees. 6. Memberships and subscriptions to professional publications. 7. Business-related travel. 8. Office supplies. 9. All expenses incurred to run your business safely and well. Make sure to keep adequate records. Some of these claims are not allowed because taxpayers do not keep proper documentation. So, keep receipts, mileage logs, or other records. You might need to produce these documents in case of an audit. 5. Higher education credit. The U.S. government offers valuable tax credits to help offset the cost of higher education. The American Opportunity Tax Credit can be claimed for the first 4 years of college. It provides a maximum credit of $2,500 per student per year. This is a credit, which means the amount is subtracted from any tax you might owe to the government. If the credit exceeds the amount of taxes you owe, up to $1,000 could be refundable. There is also the Lifetime Learning Credit, which is great for adults enhancing their education and training. This credit is worth up to $2,000 per year and helps pay for college and coursework expenses that could improve your job skills. 6. State and local tax relief. Look for ways to reduce your tax burden in state and local categories. The federal tax reform law eliminated various deductions, but many states still allow them or might have a lower threshold for claiming them. Regardless of where you live, check with your local and state tax authorities. You might see what deductions could be available for you. 7. Check if you qualify for the Earned Income Tax Credit. You might get a refund from the government even if you are not required to pay federal income taxes. For the year 2020, the Earned Income Tax Credit, EITC, is a refundable tax credit of up to $6,660. The EITC is calculated with a formula that considers income and family size. The income limits for the credit range from $15,820 for single taxpayers with no children to $56,844 for married couples filing jointly who have 3 or more children. 8. Charitable donations. It's easy to forget non-cash contributions, but charitable contributions made with payroll deductions, checks, cash, and donations of goods and clothing are still deductible. Although these deductions are often overlooked, they add up. All you need to do is itemize to claim a deduction. Since the 2017 tax reform nearly doubled the standard deduction, many people choose not to itemize. However, the Coronavirus Aid, Relief, and Economic Security Act, or the CARES Act, allows taxpayers who do not itemize to deduct cash donations up to $300 made before December 31, 2020. 9. Adjust the basis for capital gains tax when calculating the cost basis after selling a financial asset. Make sure to add all reinvested dividends that increase the cost basis and reduce the capital gain when you sell the investment. For example, if you sell your house, you might end up paying capital gains tax, especially if the value of your property has increased significantly. Single taxpayers can get an exemption of up to $250,000 of the appreciation of their homes from capital gains tax, while married couples can get an exemption of $500,000. The IRS allows you to claim the exemption once every 2 years. You can reduce the amount you owe if you have made improvements or renovations to the house. According to experts, any investment you make could be deducted from capital gains. 10. Invest in municipal bonds. Purchasing a municipal bond involves lending money to a state or local government entity for a set number of interest payments over a specific period. Once the bond reaches its maturity date, the entire amount of the original investment will be repaid. The interest on municipal bonds is exempt from federal taxes and might also be exempt from state and local taxes. This could be determined by where you live. Investors find municipal bonds attractive due to the tax-exempt interest payments. 11. Donate highly appreciated stocks to charity. You can use stocks to make charitable donations. This is another way to avoid capital gains tax. Stocks that have had large gains can be transferred directly to a donor-advised fund. Experts say that the money transferred to a donor-advised fund is not only exempt from capital gains tax but can also be deducted by those who itemize. You can start donor-advised funds with as little as $5,000. Now that you have seen the various ways you can pay fewer taxes legally, you must understand the difference between tax avoidance and tax evasion. The two may look the same, but in simple terms, one is legal while the other is criminal. Tax avoidance is legal, tax evasion is criminal. Tax avoidance helps you to pay lower tax bills by arranging your transactions so that you can reap the largest tax benefits. If properly done, this is completely legal. On the other hand, tax evasion is an attempt to reduce your tax liability by deceit or concealment. This is an offense punishable by law. The question now is, how do you know when tax avoidance efforts go beyond the legally accepted practice? The distinguishing factor is whether decisions were made with fraudulent intentions or not. When tax planning goes too far and crosses the line, it becomes illegal. This is why business owners face stricter scrutiny compared to employed workers who have the same level of income. Business owners have more options to avoid taxes, and these options could be legal or illegal. Here are some ways business owners engage in tax evasion that could get them into trouble with the IRS: deliberate underreporting or omission of income, keeping two sets of books, falsifying entries in books and records, claiming false or exaggerated deductions on a tax return, claiming personal expenses as business expenses, and hiding or transferring assets or income. It would be a good idea to seek help from a qualified tax advisor before applying any complex tax avoidance ideas. This step could save you a lot of money and also protect you from legal troubles. We are interested in discovering your personal experience on the topic. Write it in the comments and feel free to ask any questions. We will be happy to interact. Feel free to leave a comment so that we can improve the content. Your like would be the cherry on top, and click subscribe to stay informed about